Welcome to my Accounting 1110 review for final on Chapter 9. I want to spend just a little bit more time on the concept of what happens under the allowance method when you write off an account. I think it helps you understand the difference between the entry to record the expense and the entry to record the write-off. And it's always on the final. So let's do that. I guess I should have abbreviated write-off, huh? The entry to record the expense is an adjusting entry, and it's made at the end of the period, and it says bad debt expense, and it affects the income statement and allowance for bad debt accounts, and that affects the balance sheet. Like all adjusting entries, both financial statements are affected, and its purpose is to do good matching. Regardless of which method you use, the accounts receivable method or the percent of sales method, you get better matching than if you hadn't done anything at all. Now let's look at the entry to write off using the allowance method. And remember, the name tells you what account you're going to. You write off directly to the allowance account from accounts receivable, hence the name. Let's assume I did a write-off for $75 and use some of the facts I had in the previous problem. What I want you to notice is the write-off only affects the balance sheet. It doesn't affect the income statement. It's not an adjusting entry, and it's made during the period. It's made whenever you need to write off an account. If you recall in our last example, before the write-off, but after the allowance has been set up, and I'm going to use the accounts receivable method, our accounts receivable was $20,000. Our allowance for bad debt was $2,000 in the contra account. Our net realizable value, the amount that we expect to collect on our accounts receivable, is $18,000. And that's before the write-off, but after we've made our bad debt entry. I believe we use $1,750 in this example. Let's see what it looks like after the write-off, and you'll see what I mean. The entry to write it off doesn't affect the income statement at all. It only affects the balance sheet. We're going to credit accounts receivable for $75, and we're going to debit the allowance account for $75. Accounts receivable has a normal debit balance, so when I credit it, it will drop to $19,925. The allowance account normally has a credit balance, and I'm going to debit it, so that's going to make it smaller as well. And it goes to $1925. 2,000 minus 75 is $1925. And my net realizable value is still $18,000. Before the write-off, I expected to collect $18,000. Then some of what I thought would happen did happen. I wrote something off. After the write-off, I still expect to collect $18,000. What I've done is show some of what I knew was going to happen up to my accounts receivable. It doesn't change net realizable value. Just one last review of that's what I wanted you to see. Thanks for joining me. Let's move on to notes receivable.